Actually, our forecast is that core CPI is going to be close to 2% at the end of the year. So basically, we're expecting core CPI to be steady for the next 12 months. Meanwhile, if you look at headline inflation, we're expecting it to be a little bit lower, close to 1.5%, but that is based on the current oil prices. But we don't think it's going to take a lot to get higher oil prices during the next 12 months. Our commodity desk forecasts that oil could easily be at $50 or above. Production is going down, demand is steady, the market is rebalancing, and we think that this should be supportive to oil prices. If oil ends up at $50 like we expect, then headline CPI could actually easily above 2%. So we see a lot of opportunities in the inflation-linked bond markets. TIPS, the US one, is for us one of the most attractive ones. Break-even, which is the implied inflation level, for example, for a 5-year TIPS, is 1.3%. We don't think it's going to take a lot to get to 2%. So that's 70 basis points that we think makes them really attractive. But it's not just all about TIPS. For example, if you look at European linkers, if you invest in Italian linkers and look at their break-even, the implied break-even is 0.6%. So basically, what Italian linkers are telling you is that inflation for the next decade is going to be 0.6%. We don't think it's going to take a lot to be higher than that. But there's also expensive markets. If you look at UK linkers, some of them are pricing inflation north of 3%. So you can actually look at the spread between the US and the UK and make more than 1.5%. The Mexican linkers are a pretty interesting investment. The real yield is actually very attractive. It's higher than 3%. We think it's investment grade. We think it's a great balance sheet. But the reason you might want to be in linkers rather than in nominals, we like them both. But from an investor standpoint, you want to think about the volatility of your asset. One of the risks with Mexican investments could be that the currency goes down, which would mean higher imported inflation because you have to buy goods at higher price, which could translate into domestic inflation. And a good way to mitigate that risk is actually through linkers, because you know that you're capturing a high real yield, so that if inflation accelerates, you will be compensated more for that inflation. Because we've had pretty low inflation numbers for the last several years, pretty much since 2008, a lot of investors are just not concerned with inflation anymore. And that's probably the reason why the price for TIPS is unusually low. But as everybody knows, you can't insure your house when it's already on fire.